Welcome to the first edition of Wednesday webinars. I hope to present every Wednesday a short 10-minute webinar on various things you need to know about rental properties, in particular what to do before you buy. Today's webinar is about working out how much a property is going to cost you to hold. To do this, I'm going to use our cash flow calculator, which is a little Excel spreadsheet. I'll get it up on the screen just now. There we go. Share screen. And we'll just put in some figures that we can, as a typical example. Now, later on, I'll talk to you about how to find out what the likely rent the property will earn and that sort of stuff is. That's a future webinar. So let's just assume $450 a week rent and maybe 2 weeks vacancy. Then the amount borrowed, $500,000. I've got too many there. Now, I'd like you to borrow the maximum amount you can of the purchase price, even if you have to give part of your home as security on the loan. The reason being, I want to maximise the deductible debt. So the amount borrowed, the interest on that's deductible. If you put down a cash deposit, there's going to be less money that's borrowed, therefore less interest that's tax deductible. Now, even if you own your own home outright, so you've got really no non-deductible debt, that's fine. I'd still borrow the full amount and put any spare cash you've got into your offset account against that loan, so you're not paying the bank interest on it, but you've always got that money to draw out and use for private purposes if you need. You see, if you pay down the loan on the property and draw the money back out for private purposes, then you've got a mixed purpose loan. Some of the borrowing was for private purposes and some of it was for deductible purposes, so some of the interest won't be tax deductible. Whereas if you use an offset account, it has the same effect for the amount of interest you charge, but when you take money out, should you need it, you get a full deduction for all the interest on the loan. So for the sake of this example, we're going to put a 5% interest rate in. And let's say rates are $1,600, water $800, land tax, let's hope you haven't got that, building insurance, well, that varies a lot in areas, and that's certainly something you should find out in detail before you sign a contract and decide to buy. Besides, you need to insure it at the time you sign the contract anyway, so it's a worthwhile thing to do. Landlord's insurance, say $250. Body corporate fees, well, that would only be if it was a unit. We're assuming a house here. Agent management fees, we might put a little formula in here. 0.09 times the rent. See, 112. What have I done wrong? Oh, is there a dot there or something? Oh, I know, I put a times, not a asterisk. Okay, got it. So that's calculating it for us automatically, so that'll change if we choose in our what if analysis to change the rent amount. Letting fees, so maybe 1 week's rent for letting fees. Now, depreciation. Obviously, you're not going to go to the cost of purchasing a depreciation schedule for every property you're considering to buy. We have a little trick, and that is, if you click down here on this spreadsheet, it will take you to a page on our website that will estimate the depreciation using a BMT calculator. So I'm just going to stop share here, then go to share again, and I should be able to pull up the website. There it is. It's a very simple, basic calculator. So we're going to say standard house, residential, medium quality finish, 180 square metres. Estimate year of construction was, say, maybe 2011, that'll do. And Brisbane. Okay, calculate. Now over here, It gives us a minimum and a maximum. I don't use the first year of the plant and equipment because it really does, well, it should be overinflated. That's a bit strange there. I would have expected. Anyway, if you're trying to get an average of the cost of the property, so let's choose at least on the figures we've got between around year 3, and we've got to go between the minimum and the maximum. So we might say 5,000 for plant and equipment, and say 4,800 for 4,700 for capital work. So what did I say? 5,000 plant and equipment, 4,700. So I've got to stop share, go back into share screen, and go back to our calculator. So building 4,700. I'll just say about 5,000. Not that it really matters here, it's just an example. Okay, repairs and maintenance. Let's say we're having a good year, 500. Later you'll do some what if analysis and put that up a bit, and you'll notice that while the repairs and maintenance might suddenly cost you a lot of money, because you get a bit of tax back on it, it's not too bad. Let's just put in $100 for sundries. So you can see the property has cost you, as far as what you're going to put in your tax return, a loss of $18,725. Up here is $5,000 for plant equipment depreciation, $4,700 for building depreciation. That's $9,700 that you didn't have to pay anything to get the deduction for. So your actual out of pockets is only $9,000, which you can see over here in the yellow part. That's the actual cash flow. These figures are all just come across, but the depreciation hasn't. Now, the next thing we need is your tax rate. If the property is in joint names, just add your tax rates together and halve them to put the tax rate in here. So we're going to put in 39%, which is pretty high rate for negative gearing. That's sort of over $80,000 a year, but under $180,000 a year. Now, by the time you get your $7,000 refund, it only costs you $1,700 a year to hold. And remember, we said over here it was $9,000 before you got your refund. So it's a huge difference. On a per week basis, that's only $33 per week. Now, I don't want you to stop there. I want you to do some what if analysis. Say, for example, interest rates went up 6%. It's then going to cost you 3 times as much a week to hold. But you would expect, if interest rates go up, it's all because we've already had inflation. So the Reserve Bank is trying to contain inflation. And remembering they usually only move about 0.25% each time. So it might take a year for interest rates to go up 1%. So it would be reasonable to say that the rent would be at least $500 a week by then. Probably more, because not only have we had a year or two pass, we've also had a fair amount of inflation. So adjusting for that, it's still going to cost you $65 a week. So a move to 6% might cost you twice as much a week to hold. If interest rates got up to a worst case scenario of 9%, it's going to cost you $241 a week to hold. But you wouldn't get that far. It would take years, you would think, for it to go that far. You've got a lot of inflation in that time. So your rent might be $650 a week. Bring it back down to $160 to hold. Now, what I'd like to see you to make sure that you can at least handle 7% or not much over the rent you think you'll get now. Now, that's $123 a week to hold. If you can afford that, you've got the sleeping at night test passed. But even if they went up to 9%, also consider, so we put this back up to 9, that you might not be able to come up with the extra $100 a week to hold it at 9% if rents don't go up. We expect they would. If that's the case, don't forget the only way that 9% has gone up, the interest rate has gone up to 9%, is because we've had inflation. So it's been a good property to hold, one would think, because it's gone up in value. So you could, if you really feel that the 9%'s around for a long time, which is unlikely, and you're really struggling, you put it on the market and you sell it and you've made a profit anyway. So it's not like when it's your own home. It's not like when it's your own home and you've got to find somewhere to live. It's not quite that scary. Please do lots of calculations and get comfortable with your purchase. I'm going to put $5,000 here for repairs because you will have that happen sometime. And even then, it's only $293 a week to hold that year because you're getting tax back on those repairs. So I hope you will tune in for future webinars, and I hope I'll get a bit smoother at them, but I'm sure you'll find this useful information. Thank you very much for staying to the end.